Good morning.
Good morning. Good morning.
Hi,
How's
Spencer.
everybody?
Good morning. Thanks for having me.
Thanks for coming
Glad
back.
to have you. That's a beautiful background you got going on back there.
It is.
It's actually the front of our office in Emmaus. I am not
I-
sitting in front of it.
I
It's
was-
too cold outside, but
I was just going to say, you don't look cold at all.
yeah. No, you would see
the weather is nice today, though. It is warm.
you'd see our messy bedroom if I didn't have that on there.
I got to figure out how to do that and get rid of the kitchen background.
Yeah, the blur.
Yeah.
So, all right. So, Trisha, why don't we get through numbers? Apologies last week, guys, that we were not on. And thank you, Spencer, for rescheduling with us.
Thank
I
you.
had a settlement last Monday, and it was early in the morning in the Lehigh Valley area. So it threw us off a week. So our numbers are going to be this week versus 2 weeks ago.
Yep.
All right. So first, we've
New
got new
actives.
actives.
Just a little bit more, 234 versus 225.
Right. And there's not as many coming soons, but again, pretty consistent, 29 versus 34.
Under contracts are going up, so 368 from 321, and we're going to touch on that at the end.
Yes. Back on markets, we've got 33 versus 47 2 weeks ago.
Price reductions, we're seeing a reduction in price reductions, 105 versus 141 from 2 weeks ago.
And then lastly, available listings in the Montgomery, Bucks, and Lehigh County. This is total available listings, and we can see that it's slightly down, which, Spencer, you and I were going back and forth over the weekend because I had a couple properties that went under contract, and you were asking me about the loans and how many offers did I have and everything else, which prompted us to say, hey, we need to have you on again. So why don't you share with everybody what we were kind of talking about and what you have to share?
Yeah. Well, I have two things that I want to talk a little bit anecdotally about market with you guys, because you are both very active agents in the market, and I think it's worth discussing for the audience. And then I also want to talk about some changes that Fannie Mae has put out in regarding to their pricing, and how what they call LLPAs, loan level price adjusters, are going to affect rates for conventional borrowers going forward. So I'll start with the LLPAs because I think we can get through that relatively quickly. And then we can
you
discuss.
add to the stream, or do you need me to add for you?
I think I can click on this. So hold on, maybe not.
Please hold.
Yeah, it's not adding.
Okay, so I have this. Is that what you wanted to add?
Yeah, that's perfect.
Okay.
Okay, so this shows the new loan level price adjusters versus the old loan level price adjusters. It's kind of like a heat map for them. So anything that's green or yellow is actually an improvement over the current loan level price adjusters that are in place. Anything that's red or orange is a worsening. So basically, if you look at this matrix, anything that's really high loan to value ratio, which is the far right, the rates actually are going to be slightly better in those buckets. And the same with, if you look down towards the bottom, all the lower credit score stuff, that's all going to be slightly better. Okay. But then if you are kind of what we would call, I don't know, like an average borrower. So if you're putting, if you have a 745 credit score and you're putting 15% down, the price adjuster that Fannie Mae has imposed is going to be 0.75% worse, which means on a $400,000 loan, that's a $3,000 change in cost to the loan. Okay. And it just is odd, I think, in where they put these adjusters. And let me see if I can switch to a different one. I want to.
Yep.
So this is the new matrix here. And specifically, if you look at like these buckets, so right here, if you look at a 5% down conventional loan, can you guys see that, or is it too
small? Yeah, make it a little bigger. There you go.
Perfect.
Good.
So 5%, if you have a 750 credit score, which I think we would all agree is a good credit score,
right.
If you're putting 5% down, the adjustment that Fannie Mae has put in place is 0.625%. So that means the rate's going to be probably slightly higher, or you're going to have to pay 0.625% in points off of their base pricing. But look at this. If you put 15% down, which I think everyone would assume that's a better loan, right? Like that's a less risky loan. The pricing adjuster goes up to a point. And then, some of them, even in these lower buckets, like if you have a 670 credit score, which is not terrible, but there's some damage on the credit report to have that. If you do over only 3% down, the adjuster's only 1.25%. But if you go and you put 15% down or even 20% down, the adjuster's higher. So it's just mind-boggling. And from a lender perspective, concerns me. How do I explain that to a client, right? Like if they change their loan and they say, we got a gift and we're going to put 10% down instead of 5% down. How do I explain to them, that's cool. I think that's great that you're putting more down, but guess what? Now your rate's worse. So, and the one other interesting thing about this as well is they've put some loan feature adjusters in place as well. And this is the one that concerns a lot of people in the industry here. Well, I'm having a hard time.
The debt to income ratio?
Yeah. So if it goes over 40%, all of a sudden you could have adjusters in place that affect the pricing. So where that could occur is underwriters sometimes naturally across my 17 years can be a little bit conservative in their income calculations if the income they would deem isn't needed to qualify. So let's say I calculate the income and it's a hourly employee and you have to do some income averaging and I come up with, a certain amount and my debt to income ratio is at 39.5 and underwriter changes something and it goes to 40.2. Now I have this DTI ratio, or maybe we don't even do anything. The homeowner's insurance we estimate $1,200 a year. And for whatever reason, it comes in at $1,800 a year. And that takes our debt to income ratio over 40. All of a sudden we have a new pricing adjuster there too. Right. So I think this one, we've always dealt with that a little bit, especially more from the concern of does higher cost of homeowners insurance or something like that change the loan approval if it was a tight loan. But I think that new DTI ratio adjuster could cause some problems too in the middle of a transaction.
Ooh, something to look forward to.
Yeah. So this goes live with loans purchased by Fannie Mae May 1st, 2023.
Okay.
So essentially that means loans that have already closed and the lender is selling the IOU to Fannie Mae.
Okay.
So lenders are going to start putting this in place probably pretty soon. Like I would think February, March at the latest, because it takes time once the loan closes, once the transaction closes, to then package the loan and get it to Fannie. So, all right. So that's some of the one thing that they did that I think maybe is negative in some places.
Okay.
The other thing that they did, though, that's positive, and actually, Shelby, we don't have to share this because it's just a written up memo that no one wants to read. I'll just explain it. The other thing they did is they did issue a loan level price adjuster waiver for certain clients. And what those clients, the requirements to meet that waiver is you have to be a first-time home buyer. At least one person on the loan has to be a first-time home buyer. And then the household income has to be under the HUD median for the area. So this is really good because if you have a customer who's has a 680 credit score, those adjusters were pretty steep, especially if they were putting 3 or 5% down. Mm-hmm. This is kind of to help first-time home buyer make it more affordable. Right. If they're under the HUD median, which for the Allentown, Lehigh Valley, ABE area is 94,300. For Bucksmont, it's 105,400. So it's not super low income, right?
Right.
And then those loan level price adjusters go away completely, which is great for that type of customer. The interesting part is, though, you could have somebody with a 680 credit score putting 3% down, and their rate is going to be much better than someone who has a 790 credit score and puts 20% down. So it's just really interesting, some of the changes that they're putting in place right now.
Yeah.
Yeah. So those were the two things from a rate perspective, specifically on conventional loans, that I wanted to talk about. But yeah, I wanted to also talk to you guys a little bit about market conditions. So I'll tell you what I've seen and then let you guys have at it. Actually, you tell me I've talked too much already.
I love having you on, Spencer.
You guys start. So with listings, what have you seen recently? Like activity?
So I listed 2 properties in Bethlehem this month, and both had, I never even made it to the open house on the second one. We went live on a Tuesday and had 10 offers in by Thursday. And then the open house that I had done the week before had 22 sets of individuals come through the open house and had 8 offers written within 24 hours. We were under contract, and every one of them were over asking. It was interesting to me, though, on my most recent one that I just went under contract over the weekend, on the 10 offers, there was 3 conventional, no, 5 conventional, 4 FHA, and 1 VA. And of the 2 of the 4 FHAs actually asked for a full 6% seller's assist, which obviously, didn't happen. But I did see some seller assist requests, and then I did see appraisal contingencies in there as well. They weren't, ultimately we went in on offers that they were willing to pay the difference to make up the appraisal on the 2, but some of them were, more conservative.
Yeah.
So Trish, you're next. So you saw escalation clauses over list price. How about inspection waivers?
All but 2 waived inspections. One wanted the home only, and then one wanted home and wood, and then the other 8 were waived.
Okay. Yeah. And no cash though.
I did get a cash offer on one of them, but it was a condo association where the rents, they couldn't have any more investors. So one was a cash offer on one, but we couldn't accept it because they won't allow investors.
Yeah. I've been running more buyers again recently, and so that little window that we had, like right after the holidays, I was able to get a couple people under contract with seller assist even. We weren't up against multiple offers. We were able to do inspections, and now it's changing again. So one of the houses that I showed over the weekend, I think the agent said they had 30 showings over like a 2-day period. And again, calling for multiple offers on all of the houses that we saw over the weekend. We're all calling for multiple offers. So definitely getting back into that. So buyers are going to need to, again, be ready for that, because I don't know it's going to get any better right now.
Yeah. I think my past 8 clients over the past 2 weeks, all but one was multiple offer situation. Yeah. And I think, and the one that was not multiple offer situation, the house close to the turnpike and was pretty dated. So, and I think it was overpriced. So, it's amazing. It's like the holidays ended, and in my opinion, a light switch got flipped on.
Yeah, exactly.
And I don't know what your perspective is, but I think obviously it has a lot to do with rates. We're 1% to 1.5% below where we were.
Right. Which kind of happened at the same time as, the holidays ending. So
yeah. And I think that a lot of people sat on the sidelines, and it's weird, but like 5.99 sounds pretty good for an interest rate to people when they were staring at 7.5 or 7.25 before. So it's all, I think there's some perspective there that was gained. And all of the statistics that you guys showed support what we're seeing, right?
Absolutely. You look at the active listings being down, the under contract, like everything was kind of down.
Yeah.
But interest rates are going down, and now's the time to buy, and now's the time to sell. Don't wait until the spring market comes about, because everybody else is coming out then too. You have better chances of listing now. And like we said, I only got 10 offers. It wasn't 20 in the past.
Only.
And the demand for housing is not going away. The millennial
No.
generation is huge. A lot of them still are not homeowners. And the reality is anyone who's waiting for a crash in home prices is
I
going
don't
to,
think it's going to happen.
especially in our market, maybe other
Right.
markets where it got overheated, they may see some
Right.
reduction in values, but.
And I wonder if what you were talking about, Spencer, with the rates and how they're doing all of that for the conventional loans, if that's going to impact, like, are we going to have more buyers now? Because it's like,
Yeah, so
more
it's
affordable?
interesting. It may be more affordable, but it doesn't necessarily mean those lower credit score bucket borrowers, we have a very hard time getting them approved through the automated or computerized underwriting that Fannie and Freddie have in place. So even though the price adjusters may be better for them, they still might not get approved.
Okay.
They still may be FHA borrowers because of their credit profile.
Right.
Right.
Okay.
Well, that was a lot of information
Yes.
this morning, sir. Thank you so
Thank
much
you.
for bringing it up to us and notifying us of changes. I think it's really important that we educate the consumer in regards to what's happening and what is going to be happening.
Yeah, thanks for having me on. Sorry if I hijacked your show.
No, it's all good. It's all good. A lot of great
We are.
information. So, guys, if you have questions for Spencer or you want to learn more, reach out to us. We'll get you connected with him. And remember, it is still a good time to buy, and it's still a great time to sell.
Yes.
And we'll see you guys next week.
Next week.
Bye, guys.
Bye.